Very good evening to one and all. Today we have a wonderful session on plan your investment. It's a very different topic that we have, but very relevant in current times. But before we start off with the session, may I request all to place their hands on their heart for the ICI motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैत 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 एतद्द्वैत.
Yes, so friends, today we have this wonderful session, and we know that in the last year, though many businesses might not have done well, it was only the investments and the financial markets which have really earned you good returns. So it's a very interesting topic for everyone, and we need to really plan our investments well. We need to advise our clients how to go about their investment strategy, and for that we have this. Very good faculty, very experienced faculty, C. Vipul Shah, who has had years of experience in handling HNIs and their investment and their entire, structuring part. So it's been a great opportunity for us to, have him on our platform. But before we start off with the session, let me update you on a few things that we are doing at WRC. So one is that we have launched this portal coach. This project was in the pipeline for some time, for almost a year now, and then now we have finally been able to, give its wings. And this is a portal where women chartered accountants can register themselves for, employment. They can fill in the details about their specialization, years of experience, and various other things which are relevant for employment. And employers who are interested in looking at recruiting people can go on to this portal, register themselves, and they can shortlist the candidate, and then the mail will be sent, and this can be taken forward by the job seekers. So this is one thing. The other thing is we started several special focus series. We had, starting with the forensic series, we had the India series, standards on auditing. We have the WOW series, where we have women take session on technical topics on Wednesday of each month, one Wednesday each month. And for that, we have got several, applications for faculty registration. So this is a wonderful thing which has happened. We will be obviously having the DTRC in the coming month, which is also which is a highly doted kind of seminar, which spreads over 4 Saturdays of June. So we'll have the best of the faculties, and we'll have excellent topics of current interest taken up in that seminar. The other thing that we are coming up with is wills and estate planning, which is going to be in the coming week. And this is a time when we have a huge need to advise our clients on estate planning. Everybody, in fact, because at this time everybody is looking to this topic and understanding this for themselves and also for their clients. So this is a very relevant topic in current times. The next thing that we have is also on enterprise value unlocking, which will be very useful for helping your clients to build value for their businesses, or basically take steps as to ensure that the businesses build on good value so that they can then encash by way of a partner coming in, or maybe by way of an IPO, or so there are so many things which can be done if you take the right steps at the right time. The other thing that we have is also tie up with universities, and I think we have Arpit here who can tell us more about this tie up with universities, and that's the project TEL. So that is also something that we have taken up now, and we've also taken up faculty development for universities, so that we can join hands and make available our technical skill and knowledge and our practical knowledge to the university professors. May I request Arpit to share something about TEL on this platform? Arpit, over to you, please.
Thank you, madam. At the outset, congratulations for setting up a very valid program and a wonderful plan your investment city topic on this platform. It's very important for all of us now to, at least, as you said, bills and everything that we are doing, but also our existing investments. So wonderful program. Um, Friends, it's a good opportunity, and I want to take this opportunity to announce or share with you that WIRC, under leadership of Manish Bhai and Drishti Madam, me and Jayesh Bhai and the entire council, we have very passionately come to a program that is the train, earn and learn. In this program, what we are trying to do is we are trying to have a 36 hours of training for all the BCom students and bring these students into the fold of training with chartered accountant offices. So wherever that we always had that we had shortage of article trainees and all other issues that we were facing. Now we are trying to attempt to bring all the BCom, all the commerce undergrads to come take a initial training, be it on technical, be it on soft skills, be it on interviews and presentation emails, everything, and how to work with office etiquettes, how can they work with CA offices. So I think that is a very we are all very positive and very confident about this program, that we could really make sure that all our offices can really invest in these BCom grads, and they may also do chartered accountancy in near future, but yes, they would be employee ready by the end of their BCom, by getting trained under chartered accountant. So all of you who are interested, please reach out to WIRC at wirc@ici.in, and probably take the best advantage and hire as many trainees as you can, uh, as we go ahead and announce the availability of candidates on this. Also, madam, if you allow me, I would like to share one more initiative, about the Telegram channel. If This, madam. Yeah, we WIRC, in order to connect, we all know there is a huge throw of information everywhere across. So many webinars, so many this and that XYZ happening. But how to stay connected and focused? So what we have done is we have started a Telegram channel, WIRC Connect, on our Telegram. So all of you can reach out on your Telegram. You can see the global search on. You can do a global search with WIRC Connect, and please subscribe to that channel so that all the regular updates, various updates that, as Drishti Madam mentioned about the programs and about small little videos that we are creating, all of this would come in a channel format wherein no one else is interfering. It is only WIRC who will be interacting and reaching out to all for effectively communicating all its messages through the to the members. So I think we'll have a huge focused flow of information through that channel as well. So thank you once again. Over to you, Drishti Madam.
Thank you, Arpit, for your update on Telegram channel and TEL. Another thing, sorry, I'll just add one more thing about the clinics that we have started. So we are running the charitable trust re-registration clinic, where we have expert panelists. And if you have any queries on re-registration of charitable trust, then you can post your queries on this help desk that we have on WRC platform, and your queries will be answered, and it's running really very well. So this is another thing, and we have also we are also going to send out representation on the various issues which are faced in this re-registration process. Apart from this, we have also already done a representation on cooperative front. And without now wasting more time on updating everyone on what is happening at WRC, now may I request Jayesh Kala to introduce the faculty. Jayesh, over to you, please.
Thank you, Drishtiben. Thank you. It was pleasant all the members of the initiatives taken by WRC. Surprise about state. I can say under the leadership of Manish Bhai and yourself, WRC is indeed taking a lot of efforts for the value addition, knowledge addition of the members. This particular seminar, today's seminar, is very apt. Plan your investment. I still remember during my articleship tenure during the year 1994 around, there was a scheme of LIC called as Jeevan Shri, which was widely publicized by all the agents. And when we got to know about it, definitely that time there was financial was not so good. So it was like that we may take, we will not take. But the LIC agent literally pushed us कि नहीं भाई आपको तो लेना ही चाहिए ये. मतलब they even, because we were having very good relations, so they even told that we will be paying all the first installment premium, whatever you want to say, but you take it. That time we could not understand, maybe because of lack of maturity, but today we understand that Jeevan Shri was having a fixed return of almost 14.5%, which today practically we cannot even imagine to get this kind of returns. So it is all investments. If you are able to make it proper, then you can have that vision of retiring at the age of 45 to 50, because then your investments will work for you. I have seen, and many of the members can acknowledge that fact, that many of the promoters may not have earned so much in the regular business, without this their investment in property or something else must have grown multi-fold, and they must have now staying a peaceful life because of their investment, not because of their business. So if you are able to make the right investment, then I'm very sure that because of the compounding effect, because of all other effects, you will get fabulous return. And when we have Vipul Shah with us, I'm very sure that after this session, our members are going to be more enlightened so as to plan their investment properly. Vipul Bhai is a chartered accountant and a chartered financial analyst from AIMR USA. He now has almost 30 years of experience in multiple financial areas like investment, wealth management, taxation and estate planning, offshore investment, investment banking, equity research, equity broking, real estate, structured product, debt markets, corporate finance and derivatives. Before founding Impact Wealth Advisors, Vipul Bhai was managing director and heading private wealth business at JM Financial Services, one of India's leading and amongst the oldest financial services companies. At JM Wealth, the focus was on advising large business families with wealth above rupees 50 crores. His 16 years tenure at JM saw him build a wealth business from ground zero to be among the country's top five wealth firms. Before joining JM, he worked abroad as Chief Investment Officer managing money in international markets. He has also worked with other domestic institutions heading their retail and wealth business. Having done it and seen the Indian financial market from inside, he decided to step out of the active corporate role and give back to society his knowledge, learnings and earnings. He chose wealth management for a select group of ultra high net worth individual families differently. With this vision in mind, he started Impact Wealth Advisors, a boutique SEBI registered investment advisors license holder for profit social enterprise with following goals and ethos: to become an independent investment research and wealth advisory boutique with social cause, free from corporate bias and conflict. He loves to read. He is an avid reader of financial markets, economics, and financial history. He also loves to read about history, whether it is about old civilization or the modern world, about religion and philosophy, especially Jainism. He also likes to study technology, science, and nature, as he believes all of these are interconnected with finance and improves one's perspective about market, politics, and human psychology. He loves listening to all kinds of music, and his favorite in 1970s, both English and Hindi music. He also loves to travel and drive. He also has a hypothesis that reading needs to be connected with visual experience and to build one's perspective. So with this brief introduction, I'm sure that all our members are indeed fortunate to have Vipul Bhai as the faculty. So definitely, I'm sure after this session, our members will be more enlightened towards this. So thank you for this opportunity. Over to you, Drishti.
Yeah, thank you, Jayesh Bhai, for this wonderful introduction. Now, may I request our faculty for the day, Vipul Shah, to start his session, please.
Okay, am I audible?
Very well.
Yeah, thank you. First, let me say good evening to every member and participants, and thanks a lot, Drusti, Jayesh, and Arpit for such a kind introduction. What I've tried to do today is try and share my perspective of how investments have been done in my journey of last 30 years, observing various families, observing various clients investing, and also from my personal experiences of my personal investment. So I've structured it more like a discussion based on my observations of families. And let me put it this way: I've tried to create a kind of a voyage. A voyage I'm asking you to embark today is of an average middle class family, because I've touched upon the ultra HNI part more through a Q&A rather than trying to capture that here, because I'm sure that that would be more relevant to all our fellow members. Normally, an average family, as we would have seen, would work for 25, 30 years, try and build a certain surplus after taking care of his all family needs and responsibilities so that he can retire comfortably. That's a typical average middle class family which he tries to work on. And investment journey of a wealthy family, as I said, will touch very separately. So let's begin this journey by glancing what all I'm going to talk about. The few key things which I will touch upon will be: first is, why do you need to plan your investment? I'm sure you would remember visiting as a child a circus and observing a gymnast doing various acrobats high above the ground, but with a safety net below. Similarly, for every investor, having investment blueprint or plan before setting on the journey will help him on staying on course and hopefully avoid major accident. Hence, planning is very, very important before you embark on this journey of investment. Second point which I'll touch upon is the key risk and then mitigation plan. Before starting any journey, whatsoever you do in life, uh, one needs to know, and especially when it's dealing with your hard-earned money, one needs to know what kind of risk we will face in this journey and ways to navigate it so that one can handle it very carefully when one faces such kind of risk. Third point which I'll touch upon is how to start the financial planning. Irrespective of when and at what age of your life you are starting this investment journey, there are some basic steps you need to take, which we will study in this slide. The next point which I'll touch upon is measuring your or an investor who you are advising his risk appetite. Every individual I have seen in my life is very different, and so is his risk appetite and perception about risk. Measuring it or being aware of it is extremely crucial for a very stable and, I would say, safe journey of investment. Once we understand what an investor's risk appetite is, then we'll move to the next point, which is building an investment portfolio. Here we will explore how to build a unique and customized asset allocation plan based on each individual investor's specific risk return and various other constraints like liquidity, current income requirements, etc. After that, I'll share with you a few golden rules which every investor should keep, I would say, on the back of his mind while he is making investments. These are related to cost, taxation, etc. Post which we will touch upon how to review and rebalance a portfolio. Every plan needs a regular review and modification for it to achieve the desired results. And so does your investment plan. We will study some review techniques on this page. And finally, I'll try and conclude by sharing some of my key learnings in this investment journey of my 30 years, which I've spent in this market. So let's begin the journey. A moment, please.
Do you need some help in?
Yeah, I think I'm not able to move to the next slide because the first slide it moved very smoothly. Now it's not.
हाँ सर,
Uh,
कीबोर्ड के एरो से ट्राई
yeah,
कीजिए.
that also I tried with mouse also.
Okay, 1 second सर.
Sure.
सर अभी वापस आपको भेजा, देखिए सर, वापस से शो स्क्रीन करिए आप. और सर अभी माउस का की है ना आपका, पीपीटी पे क्लिक करिए, फिर चेंज करिए सर, तभी होगा सर.
Okay, okay. Thank you. Sorry for this. So let's begin with the key point, which is why do we need to invest and why do we need to plan our investment? Every individual family generates his or her surplus from his or her profession or business or job. This surplus is like a seed. If shown properly and nurtured carefully, in 20-25 years, it can grow into large tree. That is substantial wealth. This journey of seed growing into a tree, if planned carefully, will ensure every investor will fulfill his or her financial goals. Normally, every investor has two types of financial goals, which I have classified them as level 1 and level 2. Level 1 are the immediate or the short-term goals, and their fulfillment is most important for the family's well-being. They include goals like child education, marriage, purchase of a large house, and various such things. While level 2 goals are more long-term in nature and sometimes even aspirational, which if achieved, makes the investor and his family future secured. Example, creating a large wealth pool, or as our fellow members said, creating a, as I call, a FIRE plan, which is financial independence and retire early. But these goals need to be approached in a different manner, though they are intermingled. So why am I emphasizing again and again on planning? Why is it so critical? Let me share with you the three biggest enemies, if I were to say, or the hurdles which I have seen in achieving one's above two levels of financial goals. One is time. The earlier one begins his or her investment journey, more chances of him or her achieving the financial goals. Second is market volatility. Every investor, trust me, is bound to face market volatility in his journey. He just cannot avoid it. An unplanned investor can easily get derailed when he's hit by such market volatility due to no or weak risk mitigation plan. A third important hurdle or enemy, I would say, is taxation. One cannot avoid it, but one can definitely reduce it by implementing a good tax planning. And today I am talking to some of the best people who understand this far better than anybody in this country. I'm not an expert, I would say, because I am not into practicing, but I'll give you a very simple example of a tax planning which can make such a substantial impact in 20-25 years of your investment journey. Typically, the key earning member, as I've always seen, is in the highest tax bracket. Even if he can legitimately gift a certain sum of money to his blood relationship, who typically would be in a lower tax bracket, and in that process, it just saves a lakh of rupee annually in his tax outgo. Trust me, in 25 years, this 1 lakh saving annually can lead to 67.8 lakh rupees of extra corpus for the family just by compounding it at 10%. So this is the kind of impact a simple tax planning tool can do. And I'm sure you would have tons of such solutions where it's not about saving 1 lakh rupee, it could be saving several lakh rupees. And this you can see what impact it does in 25 years. It can land up saving or creating an additional corpus of crores of rupees. But strangely, I've seen a lot of investors ignore these things, and hence this whole financial planning and power of compounding needs to be understood a lot more carefully and planned accordingly. Let's move to the next point. As I said, before any kind of investment journey or any journey is embarked upon, one needs to know the risk which one is going to face in this journey, because that helps you in facing them far more carefully and safely. Some of the risk I've listed out, there are a lot many more, but this is just a food for thought for you to think. And this helps you when you are structuring your portfolio or your client's portfolio so that it can manage and navigate those risks. What are some of the key risks? One is key member or key earning members risk. In early stage of family wealth building phase, losing the key member on whose earnings the family will depend upon or whose well-being of the family is dependent on can be very devastating. And hence, one needs to have some mitigation, which is having a proper term plan, which is very critical as a part of your investment planning. Similarly, any large unexpected health expenditure I have seen can derail families' investment plan, and hence buying a reasonable health insurance too is critical in early stages of family wealth life cycle. The key pushback to both the above risk is yearly cost. And a lot of time I've seen that people try and avoid this by saying that, why should I incur this cost? Surprisingly, if you start early in your life, both these costs are far lower and they become a base for future too. So if you take a term plan at a very young age, you'll end up paying largely the same amount of premium all through your life. So it's again very, very critical to start early and plan your investments well. Moreover, everything cannot be looked from the lens of cost. And over optimization of investment portfolio or excessive focus on return can at times wreck the whole plan. Hence, do bear in mind that some costs are good and you should incur them. Another risk which one needs to factor in is current income. I've seen there are times, and especially a lot of us would have observed in this current COVID situation, that all of a sudden the business job income or the profession income on which the family's well-being is dependent on suddenly starts depleting. In such situations, if you have invested in your surpluses, some part of it at least, in assets which generate you regular income, then it helps you in mitigating the risk. So why I'm listing this out as a risk is that when you will start planning your or your client's portfolio, you should start thinking through each of this lens or each of this filter and see that is my portfolio at least capturing some part of my portfolio is capturing some of this risk, and is it mitigating that? Another risk which I have seen is liquidity and solvency risk. Again, this becomes very relevant during crisis because I've seen, especially in our country, most of the asset classes tend to become strongly correlated during crisis, which means that your equities go down, your debt values start falling, your real estate also becomes extremely illiquid and the value starts depleting. So one needs to plan the portfolio in such a manner that there is always a certain amount of liquidity available which one can use during the crisis. And how one does is by doing a proper asset diversification, investing in some low correlated assets, which we'll touch upon a little later. Another very important risk which you need to keep in mind while planning your investment is inflation and deflation risk. Inflation actually is one of the biggest risks we have faced in our last 70 years of Indian history, which I'm sure all of us have been, even today, are facing. And hence, if we don't invest our assets properly, especially in growth assets, then the real value of those assets is depreciating. The buying power of those assets is depreciating. Another risk which till date India has not faced, but one cannot know what the future has for us. And we have seen one of the large nations already going through it, which is Japan, is the deflation risk. And trust me, deflation can also be as devastating on your portfolio as an inflation can. Hence, planning and mitigating that risk also, I would say, is an advisable thing. And one way to do it is investing into long dated AAA bonds. Like just now at the beginning, Jess mentioned about an LIC policy, which probably was a long-term debt instrument under the wrapper of an insurance policy, which could give you a very high return. So such kind of instruments also should be part of your portfolio, and it helps you in managing this risk if it comes. Another risk is market risk, which though we cannot avoid it, but there are ways to mitigate it. Also, another risk which I have seen some people tend to take, not everybody, is excessive leverage. That one has to keep it at a manageable level. Otherwise, during crisis, that can act like a double-edged sword and have a very devastating impact on your portfolio. Few other risks which one needs to keep in mind is concentration risk, country risk, credit risk, which are all manageable if one uses proper planning and does a sound research. And finally, I would say another risk which all the families need to be carefully planning about is wealth transfer risk. Because a lot of time I have seen that the key member during his strong earning period is so focused on the earnings, and the rest of the family is not so interested in the wealth and the issues related to wealth, that if God forbid something happens to that key member, the family, despite so much of money left behind, is clueless of how to manage. And I have seen that unfortunately every industry has, I would say, some black sheeps, and then you tend to get wrong advices, and a lot of hard-earned money can actually be lost. So there too, there should be a proper planning, hand-holding, thinking through that how the next generation can handle the wealth properly. And the last is estate tax. If in case that comes, then that could be another issue which one needs to plan for. A simple mitigation tools, which all of you would be aware, would be having a nomination in every investment which you do, and having a very simple will just written or even on a plain paper can at times take care of some of these challenges. Once we have understood the risk, we now can start thinking of how to do the financial planning or where to begin it. For a good and realistic financial planning, knowing where one stands is very crucial. It makes no sense to build an unrealistic plan or goal, which are either based on over-optimistic return assumptions or on large capital allocation which may never take place. Such kind of plans are bound to fail. So one needs to think through and start properly. Where does one begin with? The first thing to do is always take stock of your or your investors' current assets and liabilities, so that one knows where one stands and can start planning from there. The next thing to do is ideally to estimate your next 5 years income, expenditures, and surpluses. Why I'm saying 5 years? Because thinking beyond that most of the time doesn't make sense. One cannot see too much of a distant future. We are all seeing how volatile this world is. And one can keep on rolling it upwards as we move into future years. Third important thing to do is list out all major expenditures and their estimated timelines. Like if you want to send your kid for an foreign education, or you have a kid's marriage, or as I said, some you want to buy a house property, various expenditures, try and pen them down, put some kind of timeline around it. You know what broad range of time you will need this money, what kind of value you will need, so that you know that what kind of different capital expenditures, if I were to call them, are expected at what time periods, which helps you when you decide selecting the tenors of your investments and also deciding how much risk you can take depending on the time period which you have. This will help you in achieving some of your, as I had categorized, level 1 goals, which are the short-term goals. Second thing which you need to do planning for, and this is also which you need to do simultaneously, is start planning for your FIRE plan, which is financial independence and retire early plan. How does one do that? The best way to do it is estimate your current household expenditure, try and capture all possible expenses which you can think of, and then add an inflation to it and say that if you today are of an age of 35 and propose to retire at an age of 55, so add a compounded by 20 years so that you know that what roughly you will have an household expenditure at the age of 55. Once you have that rough estimate, a simple thumb rule methodology is that you should have at least say 50x of that value. So assuming that value is 20 lakh rupees, which you believe will be your household expenditure when you reach an age of 55, multiply that by 50, which would mean that you need at least 10 crore rupees for you to retire, or for your family to have a very peaceful and an accomplished life. So this is a very basic thumb rule methodology by which you can say that what is the terminal wealth which you need to accumulate, and then start working backwards to see that how do I achieve that terminal wealth? Where do I invest? What kind of expected return I can, looking at the history, expect my portfolio to generate, and will I achieve, or do I need to invest some more money to achieve my FIRE plan? One important thing to keep in mind is ideally try and keep some of the large unmet capital expenditure outside this corpus, which means that keep some money aside for that, which could be probably a child marriage which is still pending, or some kid education which is pending. Plus also always have a separate decent health insurance cover. And luckily now there are enough and more such plans available. So this is, I would say, a good point or a good starting point to begin with. For families who have substantial wealth, the above points may not be relevant, or some of them may not be relevant because their basic needs are already taken care of. They will have to begin in a very different manner. Either they will have to define a kind of a terminal wealth they are looking for, like what you try to do when you try to estimate your FIRE plan value and then work backwards, or they would define their parameters of what risk return they have in mind, and then you have to build an asset allocation accordingly. So different, I would say, wealth levels needs a different way of handling the financial planning. Once we have understood and once we have begun this journey by making this estimate, the next thing we should do is what I call measuring the investor's risk appetite. Remember, like each human physiology is unique, so is his mental construct of risk perspective. We all believe we are rational thinkers and are bombarded by such theories. My simple case in point that if humans were rational and would have strong capabilities to learn from past histories and mistakes, there would have not been so many booms and bust cycles which we have seen in last probably 500 years or 1000 years of human financial history. Hence, let's all first understand and accept we all have mental biases and we are not perfect. Accepting this fact helps in reducing mistakes and not getting dejected when we make mistakes, because we are bound to make mistakes. One more point I would like to emphasize here is there cannot be a zero risk scenario. If investor wants to avoid all kinds of risk, then he will have to just buy an RBI bond in simple terms and be happy with that kind of a return. So the point is that there is no free lunch. One has to take a risk. What I've tried to do here is, and I'm sure you can see the slide, is I've tried to put a very simple example or a model to gauge a person's individual risk appetite or an investor's risk appetite, which you can use when you want to judge your client's risk appetite. I've tried to put a simple asset allocation, which has just 3 asset classes: equity, debt, and cash, and put 2 types of investor. One is aggressive and another is conservative investor. In an aggressive investor, as you can see, I have kept 70% of his assets invested in equity, 25% in debt, 5% in cash. While in conservative, the equity allocation is 30%, debt is 65%, and cash is 5%. I've just tried to create a 10 crore portfolio using these parameters and with the expected returns. Obviously, when you see the returns, every investor feels I want to be closer to the aggressive model. But now take a step back and think of your or your investor's emotional or psychological state if you are facing a situation where equity values are down 70%, debt is down say by 10%, because when economic crisis hits you, even there is credit risk and interest rate movements which can also deplete the value of your bond investments. In such a situation, an aggressive portfolio, which we started with 10 crore value, would be down to 4.85 crores, while a conservative portfolio of 10 crore value will be down to 7.25 crores. Just pause for a moment here and think what would be the emotional state of mind when a person sees his 10 crore portfolio is down to 4.85 crores. And this is not a fictional story. It was a real situation I have seen in March 2009. And actually, I'm sure all of you might have seen to lesser extent in March 20 also. Now, as an investor, my next question would be, what would he do in such a situation when he's in the thick of such a situation? Will he exit in that crisis, sell all his equities and invest into something which he believes is the safest? Or after a year or year and a half or two, when the market recovers, he jumps out of the ship? Most of the investors, after you share this kind of a narrative or an example, will say that they will continue to remain invested. This is because they have an advantage of hindsight. They know what the outcome was. But when the situation, when there was an actual turmoil, trust me, at that point of time, you didn't know whether the markets would recover or they will fall further. Hence, at that point of time, you just couldn't take that decision saying I'll stay invested or I'll add to my investment. This is the real, I would say, way of evaluating one's risk appetite. If you are of the mindset that yes, you can stomach such a fall, then an aggressive portfolio makes sense for you. If you are of a mindset who believes that this is a mistake, I should have not invested so much money into equity or into risky assets, then you should look at some conservative style of investment. Just looking at statistical numbers of volatility and standard deviations and efficient frontiers and so many things I can talk about if I were to give you the so-called technical lingo, I don't think that really captures the human emotions. Knowing human emotions is so critical in managing one's investment portfolio, because this helps you in not jumping out of the ship at the wrong point of time, not derailing your investment plan. So this is what I believe is very, very crucial before you even start building your portfolio. So now once we have understood the risk measuring methodology and we know that what is the risk bearing capacity of an investor, the next step we should do is building an investment portfolio. Building an investment portfolio is both simple as well as a complex job. Remember a few minutes ago, I had shared my thoughts on various risks like liquidity risk, current income risk, inflation risk, market risk, concentration risk, so many of them. While building investment portfolio, one has to pass every investment idea through the filters of all these risks, plus decide the tenor of each investment depending on the liquidity requirements and factor current income. Plus, you also have to keep in mind the tax implications of each investment. On top of all this, one needs to compare different investment options on risk return parameters to find ones which give the highest possible return for a given risk. Furthermore, one needs to have some macroeconomic perspective of both local and global markets, interest rate environment, and most important is some understanding of asset valuation. Overpaying for any asset will always reduce your return, irrespective of how long your time horizon is. If one doesn't have a time and inclination to do all this analysis, one can always engage an expert to help you to do this. Building investment portfolio needs a fine balance. One side, you need to balance all the risk, investment constraints, tax, cost implications, and on the other end, you need to synchronize them with your short-term and long-term financial goals. Why am I saying this? Let me give you one example. You may, based on your research, at a particular point of time when you have surplus or you're planning to build your investment portfolio, find real estate very reasonably priced. So you may think that currently the best thing to do is put most of your surpluses into real estate. So from a return perspective, this is a very logical decision to make. But now think that there is an unmet financial goal. You need to send your son or your daughter to a foreign education after 3-4 years. If you invest your large part of money into, at that point of time, the best return generating asset, which is real estate, God forbid if within 3-4 years there is some kind of crisis, we all know how illiquid the real estate becomes. In that situation, you cannot tell your kid that, sorry, now I can't fund your college education, or you have to wait for a year or two till the market stabilizes. So the crucial thing which I'm trying to highlight here is that while building your portfolio, you have to look at from every angle. Another important decision investor needs to take while building his or her investment portfolio, after considering all the risk mitigation strategies, is to define the investment weights. How much money will I invest? Like I gave you that earlier example in that simple asset allocation, how much goes into equity, how much goes into debt. But in real world, when you build your asset allocation, you will have to define weights for not only equity, debt, also real estate, also gold, also alternate assets, even offshore assets, some credit risk assets, how much to put in large cap, how much to put in small caps, etc., etc. Further, some of these decisions are in fact dynamic and may change with time and economic cycles. So how does an investor really goes about doing this? I have seen some investors decide these weights based on their understanding of a certain asset class, or their comfort with a certain asset class, or their experience with a particular asset class. Example, some investors prefer to invest only in bank FD, as they may have seen in past some of their close friend or family member, due to some wrong selection or maybe taking leverage, might have lost substantial sum of money, and hence he believes that investing in equities, gambling, taking risk is foolish. Similarly, I've seen a lot of investors, because of their very successful past experiences of real estate giving a great return, tend to invest lion's share of their wealth only into real estate. So there's no simple answer or a perfect answer, but as I told you, that if once you start thinking through all the risk filters, you will realize that this is not a right way of investing or managing your money. A more scientific way is to decide asset class weights based on the criteria like return, time horizon, taxation, risk bearing capacity, and various other, as I've shared, risk filters like inflation, deflation, current income, solvency requirements, etc. Once you have built some kind of a asset allocation model for you or your client, you can actually also create certain scenarios and run them expecting what kind of different return or risk may play out in next 5, 10, 15, 20 years, and see that what kind of terminal value your portfolio is able to arrive at. Is it closer to what your desired goals are? Is the risk comforting you? And based on that, you can tweak your asset allocation. So there are various ways to fine tune them. There are some mathematical models also which can help you there. Like as I say, one tries to build efficient frontier, and one needs to factor in various correlations between various asset classes, their variances, their returns, risk, etc. And one can come up with a decent number, provided you have enough historical data to do all this analysis. Or else there is a very simple thumb rule, as I've just shared with you, that what is your comfort with risk and what kind of terminal wealth you're looking for, and try and juggle around with that. Few other important aspects while building investment portfolio are selection of stock or investments, timing of market, when to buy, when to sell, cost of investment. In fact, this is one of the most, I would say, ignored aspect of investment, and I'll touch upon that a little in detail in our next slides. But finding the cheapest investment instruments is extremely crucial in creating a long-term large wealth. Unless you are a full-time investment practitioner, stock selection and timing are very difficult. The best solution is to give it to an expert to address these issues. But if one still wants to do it, there are methods of doing things like doing SIP, a simple systematic investment plan, or investing into exchange traded funds, ETFs. This could be good techniques. Once you have built this portfolio, or you're working to build this portfolio, there are a few golden rules I would suggest, which you should keep in the back of your mind. Since one has limited capital, Capital allocation is the most important decision in investing. Selection of right investments hence becomes a foundation of portfolio building, and it needs a lot of research and experience to take right decisions. As I said just a second back, cost of investment. This is one of the most important, I would feel, aspect of investment, which is most of the time ignored or never shared to the investors by the so-called distributors or investment advisors. I'll give you a simple example of my recent experience. Like what Jayesh mentioned, maybe 20, 30 years back, there was an LIC policy. There is a similar kind of a policy of HDFC Life Sanchay Plan, which is like a bond, which gives you a certain fixed return over 20, 25 years, wrapped in an insurance policy so that it becomes tax efficient. You would be surprised for a 1 crore cover if you were to invest it directly by going onto the company's website and doing things yourself, which is very simple to do, or you would do it through an insurance agent. The difference or the saving is 20 lakh rupees in 20, 25 years. This is the kind of saving just on a crore rupees of investment. If you do a simple math, if you are able to save even 1% cost of investment on a 1 crore portfolio, in 15 years, you can actually get back 50% of your capital. It takes away 50 lakh rupees, just 1% cost annually on a 10% portfolio compounding. How do you do this? There are again simple methods of doing it. Investing into exchange traded funds, investing into direct plans of insurances and mutual funds. Like, to give you an example today, a broker advised or a distributor advised equity mutual fund may cost you maybe 2% or 1.5 or 1.75%. While if the same thing you can do through a direct plan, which will cost you roughly half of it, which means against a 2%, it may actually cost you just 1% or even lower. Similarly, if you were to invest into only large cap companies, you believe you don't want to take risk on the middle, small caps and mid caps, you would go and buy a exchange traded ETF. An ETF costs just 5 basis points against a actively managed equity large cap fund, which may cost you 200 basis points. So you can see the saving is 1.95%. So point which I'm making is that this is very, very crucial that you should save cost and you should not ignore this at all. Third important, I would say, rule which you need to keep in mind, as I've already shared in past, is have adequate liquidity. Why I keep on repeating this is because there will be crisis. There will be need of urgent cash, and you don't want to throw away your assets at some low prices during crisis when you need those money. So you plan your portfolio in such a manner that you also invest into long dated assets, but you also invest into certain short dated assets. Another important thing which I've already shared with you is tax efficiency. A penny saved is penny earned. And as I shared with you, just 1 lakh rupee of annual tax saving in 25 years leads to 67.8 lakh rupees of additional corpus to the family. There are also various other ways to improve your tax efficiency when you need certain money for your kids' education or the different goals which you have set, by investing in such a laddered manner so that you don't land up paying higher tax. To give you an example, today if you were to invest into, let's say, a bond directly and you were to earn coupon, and if you're at the highest tax bracket, you will end up paying 35 or 40% depending on the surcharge which is applicable to you. The same bond with the same risk characteristics, if you invest through a mutual fund, a debt mutual fund, at the end of 3 years, the tax is only 20%. And that too, you get an indexation. So the effective tax rate from almost 35 or 40% comes down to 10%. So this is the kind of difference which you can bring to your client when you advise him with right tax efficiency, and when you capture all those points when you are making the investment decisions. Last important other point which you should always keep in mind is diversification. Diversification has a little, I would say, a unique impact. If you are over diversified, you don't tend to make great return. And actually over diversification doesn't even reduce your risk. And a lot of time when you look back and study any major successful investor's history, he would have made large wealth through not diversification, but through concentration. If you look at Bill Gates, or you look at Warren Buffett, or you look at any other large wealthy family, they would have made large money because of their holding in one or few select assets which are very successful. But this works when you don't have other financial responsibilities. When you have to factor all your other family financial responsibilities, then you can't look at only from the lens of return. You need to diversify and reduce your risk. So there is a fine balance, if I were to say, between concentration and diversification to balance your risk return profile. Let me start this slide about reviewing and rebalancing your investment plan by one sentence, which I would say you should cast it in stone and keep it on your desk. No one knows the future. And when I'm saying this, trust me, you will come across all great advisors and market pundits who are projecting and predicting the future every day. But trust me, no one knows the future. Which is why the best investment gurus have often quoted, investment is an art and not a science. This means that whatever we plan, no matter how hard we try, the final outcome will be different than what was initially proposed or visualized. Which is why a constant monitoring and rebalancing of investment portfolio is critical to stay on course and manage changing circumstances. Here, what I've tried to capture is what are the 2 or 3 critical things which one needs to look at while reviewing and rebalancing your portfolio. One is that you need to review and rebalance when there is a major event, either in your personal investor's family life, like there is a increase or decrease in one's annual surpluses which one generates, emergence of a new investment opportunity, or change in the risk of an existing investment, an unplanned expenditure, a major event in economy like we recently have seen COVID-19 or 2008 global financial crisis or 2013 Indian crisis. Any such major event needs you to go back to your drawing board, relook at the investment portfolio because the risk has changed. Probably the return expectations have changed. A lot of factors which go into deciding the portfolio, which we discussed in the previous slides, they may have changed. So you need to review them. Another reason why you may want to review and rebalance is when you have achieved financial goal. Let's say we took an example of a child education and you had invested your portfolio in a particular manner, expecting a certain return, and the return turned out to be better than what you had expected. Then the best thing to do is, rather than waiting till the last day when you need to spend the money, change the portfolio, de-risk the portfolio, and probably sit more on debt rather than on risky assets. Because as I said in the beginning, you don't know the future. And what you have seen, great returns may go down. So that could be one reason why you should change your investment plan when you have achieved your financial goal. Second reason when you should, on a long-term basis, look at reviewing is when you're coming closer to your retirement age or to your financial goals, as I just shared with you. At those points of time, like if you had decided I would like to retire at an age of 50 and you are at the 48th year, you should now start thinking of how to reduce the risk and not wait till the last day, because you don't want, if your portfolio has already come close to what your targeted goal was, you don't want to lose that money which you have created. On top of this, there should always be a semi-annual or annual review to ensure that the investment plan is on track. And does it need any rebalancing due to substantial movement in single investment or asset class? Because there are times when a particular, assuming you had bought into a certain real estate and that asset price in last few years have really gone multiple fold, which is far higher than the expected return which you had built in. Maybe it's time for you to trim down, or same could be for a stock or something. Or if the interest rates have collapsed to such a level and you had invested into long dated bonds, their value would have appreciated substantially. Maybe it's time to come out of them and invest into something else. So these are some of the key things which you need to keep in mind while reviewing and rebalancing your portfolio. Finally, I want to conclude by sharing some of my key learnings through the investment journey which I have done in the last 30 years. Let me start with saying there is no single good technique to create a great portfolio. Every individual can develop his own style which suits his own risk and mental mood. Copying a successful investor technique is no guarantee for success, as there are several random factors which create that success, and it is impossible to know or list them. In fact, if you were to ask that successful investor, he himself would not know which random factors has really helped him to be so much successful. So let's look at some of these simple rules or the learnings which I have seen. Start early, which we all have seen and discussed and heard. The sooner you start, it is not only about the power of compounding which you get the benefit, but you also gain investment wisdom and confidence. I've learned one thing: no matter how much you learn in theory, and I'm sure each of us, when we were studying for a CA, and then when we got into real practice, we realized that how different the theory and practice is. So you need to start that experience as early as possible, and the wisdom and the confidence you gain by doing that will help you in your journey in those 25, 30 years. Another important thing is stick to your asset allocation. Don't try and time markets. The most important thing, which always I've seen, is time spent in the market and not time in the market. So it's very important that once you have drawn your asset allocation, thought through all the risk, return expectations, all the constraints, stick to it. In fact, one of the reasons, if you would have seen, a lot of people have made great money in real estate is because they have remained invested in it for 10, 15, 20, 30 years, and they don't keep on seeing daily prices. They don't keep on trying to buy or sell something. So this is one very crucial factor in successful investment journey, is to stick to your asset allocation. Another important thing is self-discipline. As I shared with you, investment is a personal journey. Every individual has his own unique style, own unique risk mental models. Don't try and ape and copy somebody else. Don't get carried away by looking at the crowd's euphoria and panics and trying to take decisions based on that. That's where self-discipline, and this all will come from experiences. No matter how much I tell you, how much you will read, this all, when you will go through your personal journey, you will be able to understand them. Another very important thing which I'm reiterating is the tax efficiency, which I'm sure you all understand the best. Another important thing is habit of saving. As we have seen the power of compounding and everybody understands that, the most important thing to do is try and allocate larger sums of money in the beginning of your investment journey. And that's where the big conflict is, because you want to have a, let's say, a vacation abroad, or should you save that money? This kind of a conflict, I would say, try and go for the later as much as possible. I'm not saying that you can give away all your personal experiences or the fun which you want to have, but try and see as much as you can delay or defer your expenditures and try and use that money to save, because assuming that you have invested very properly, within 3, 4, 5 years that money can probably double. And if that is the case, what you're planning to spend that for, you're virtually been able to spend after 3, 4, 5 years and still have the money left with you. So hence this habit of saving at the early stage of life and at every stage of life is very, very crucial. Another very important thing, as I already mentioned, is saving cost on investment. I'm again reiterating, just one simple 1% extra annual cost savings in 15 years can add almost 50% of your initial corpus. That's the kind of impact when you do your investments wisely and look at every smallest cost which you incur. And last and final, as I say, find your own risk capacity and stick to it. Don't try and copy or mimic somebody else. See what suits you, and this will allow you to stay on your track and achieve your financial goals. Let me end this by saying, wishing you a successful investment journey. I'm open to question and answers.
Krishnaji?
maybe. हाँ
Questions
मैडम,
है?
हाँ मैम दे रहा हूँ,
Questions?
हाँ मैम दे रहा हूँ.
This was a very interesting session.
Thanks, Srishti. I hope everybody found it useful.
So here are the questions on your screen, if you can see.
I'm not able to see it, Srishti. So what should I do? Yeah, now I can see them. Okay. Yeah,
Okay.
they're there. So shall I start with question number 1? Yeah.
Sure.
Okay. So I'll repeat for everybody's benefit. Somebody is asking, Vipul, is insurance investment product give enough returns, or should we keep insurance and investment separate? I think you have to keep this separate. Use insurance only for your risk part of it and where it is tax efficient. I gave you one example of HDFC Life Sanchay plan, which is actually a bond and which has very limited risk cost built into it. So if it gives you a kind of a guaranteed return, which is equivalent or better post-tax compared to, but I'm using the word guaranteed, then you can use the wrapper of insurance. Else only use simple term plans which are low cost. Don't mix both of them at all. Next question is, in the bond example, if we invest through a mutual fund, we get a lower tax. But doesn't MF have to pay tax on the earnings of the bond and investment, or are they exempt? They are exempt. So this is an advantage which government has given us and we should use it. Next question, before starting to invest, what basic things need to be sorted, like life, health insurance, etc.? I think 3-4 things it needs to be sorted. One is that ideally you should have your own house, because that's one very important thing, and have enough money which can take care of your family's basic requirements, which is your kids' education, their basic lifestyle, etc. I think those are some of the basic things which you need to sort out before you start investing surpluses into assets which are volatile. And let me again clarify, volatility and risk are two different. Volatility means an asset price may go up and down, but they may come back to where you started as long as the underlying investment is good. Risk is where you actually lose money. And that is something very crucial for you to understand when you are taking those decisions. Next question is it okay if we invest on our own through SIP? For this, should we directly subscribe through MF website or by agent? It's absolutely okay. to invest through your own through SIP, and there are enough websites which provide you enough research free of cost, as long as you have the inclination to study them. And you can invest through each individual mutual fund website. In fact, there are also some aggregator websites which also allow you to do that at a very minimal cost. What will be the opinion on MLD as a product? I think it's an interesting product. It allows you to reduce your tax outgo. As long as there is tax efficiency, there is no harm because the underlying risk is same. What are your views on cryptocurrency? Honestly, I don't have any view on cryptocurrency. Should an aggressive investor look at SIP? Why not? Because this helps you finally see there is nothing like aggressive or a conservative investor. That plays an important role in deciding how much to invest into risky asset. Then how to invest, one can definitely use the same methodology. So SIP could be effectively useful for both an aggressive as well as a conservative investor. Very concise and well presented. This is definitely thanks. Okay, so somebody is just thanking. Vipul, since Bitcoin has been categorized as an asset now among the startup circle, what is your take? Sorry, I don't have a view on Bitcoin. Can you suggest a sample investment package for a CA in practice? I guess, as I said, one needs to understand that each individual's risk return. For me to, I cannot give a generic answer to this. Maybe I think my presentation carries my email ID. I can later on you can connect and I can help you on this. What about sovereign gold funds? It's a brilliant suggestion, and that is one of a very again effective tool when you have to make an allocation to gold. This is a very excellent tool which you should use at times even better than the physical gold, because it's also more tax efficient than the physical gold. If a person is investing through SIP for say 20-25 years and having a corpus of say 1.5 crores after 20-25 years, but as we know, because of time value of money, this amount may not be sufficient to fulfill the expenditure. How to overcome with this kind of problem? This, I think, which I touched upon in my slide, where, as I said, the best thing to do is first estimate your household expenditure today, then add inflation to it to the age where you want to retire. Once you know what that expenditure is, one methodology, as I shared with you, as a simple thumb rule, you can have a 25, 50 times that value of that money, and that could take care of this issue. And then you have to work backwards and plan your investments accordingly. So to answer your question in one line, you'll need to plan your asset allocation in such a manner that it's just not, your value of assets are just not 1.5 crore, but they are larger. And for that, if you need to invest some more money at this stage and this juncture, you will have to do that and maybe sacrifice some of your current expenditures. Next question is one more question. What will you advise? Yeah, sorry.
I think there are some questions which have scrolled up, which have gone unanswered. Mishra ji, I think from
I think the last was 1.5 crore question. And anyway, try and cover as much as.
And question number?
I think maybe 2-3 questions about this. Yes, we are there. Yeah. So now the next question is, what needs to be done for monthly return on investments for managing monthly expense? So this is where I had touched upon the current income requirement. So you will have to invest in assets which generate you current income, plus to ensure tax efficiency, you may invest also in a laddered manner, or there is something called a systematic withdrawal plan, where what happens is that you are withdrawing almost 95% or 96% of your capital and only 3-4% of your return. So the tax paid is only on the 3-4% and not on the 95%, and you can plan it in such a manner that eventually you get your monthly expenditures taken care at the least cost. So this again, I'm sure either you or your investment advisor can help you on this. One of my client, age 75, was retired, received 12 crore rupees by selling his old investment. Is that the best way to invest this money? A simple answer is yes, but then as I said that today the life expectancy of people is increasing, and who knows, he may live for another 25 years. And if that is the case, then the inflation will really hurt his real wealth. So you may need to look at investing more in a conservative manner where there is some growth cap assets also in this portfolio and just not fixed deposit. What is the future of gold in modern world environment? See, as I said, first cardinal principle is never try and predict future. The best thing to do is have a mix of everything so that it balances your portfolio. And gold is important because we don't know, and we have always seen that when there is an unknown risk which hits the world, be it the financial crisis or some natural calamity, or like what we have seen right now, COVID-19, or some, let's say, a war or something, gold is this asset which will have the store of value. So hence having that even in the modern world, I believe to some extent is important. Then the next question is, what is your advice on using LRS? So I've already touched upon offshore investment. Depending on the size of your wealth, managing or hedging country risk is also as critical as any other risk, because we all today have our entire eggs in one country, which is India, and it is risky no matter what we like to believe as a nationalist or patriotic individuals, and hence using LRS and investing into offshore markets is very important. Yes, there are various ways and means to do it. One can use some of the funds, or one can do direct. Next question is, you said about direct plans, then how financial planner will help us if they don't get commission? SEBI has come out, and this is what I do for my large ultra HNI families. I am a registered investment advisor, which means that I charge a fee to my client and ensure that he invests only and only in direct plans. So this way, the interest of both the client and the advisor is aligned. So you need to just find an advisor who can do this for me. Mishraji, again, I think, thank you. Yeah, that's it. Then, which is beneficial and interest to invest in real estate or share market? As I just addressed to you, I think both as an asset class can give you a decent return, but you need to balance that with all the other risk and liquidity requirements, and then decide what is the right mix for it. NPS is a good option for wealth creation. Absolutely right. A good suggestion, and this is a good option and is also tax efficient. So you should use that. Can you please walk us through how you arrived 10 crores for a 50-year individual? I've just did a simple math there, saying that his expenditure at the age of 50, his household expenditure at the age of 50 is 20 lakh rupees annually. And I said that as a thumb rule, he should have 50 times the wealth of his annual expenditure. So 50 into 20 lakhs is equal to 10 crore rupees. So at the age of 50, he should ideally have a corpus of 10 crore so that he can very easily and comfortably have his retirement. This was the math behind that. Gold is not considered in your asset class, which is correct percentage. I did mention gold as an asset class. In that simple thing which I had done, I just, to keep it simple, I kept equity, debt, and cash. But gold is definitely an important asset class, and it should have certain percentage in your portfolio. The last question I see is, person who is already retired, where should he invest his savings? Example, where one should invest the FD, which are maturing after 9% return. I think there are good debt instruments which he can look to invest. Like recently, there was something called Power Grid InvIT, which was a Navratna PSU coming up with an InvIT, which was giving almost 9 to 10% return for future 20 years potentially. So you need to look at, and your advisor need to look at such vehicles and instruments which don't take risk, but can generate you at least between 8 to 10% return. What are the different categories of debt mutual fund, and what are underlying factors to derive that NAV? It's a very long thing which I cannot touch upon right now, but I'm sure if you do a Google, there is enough data available for you to understand. To make it simple, you can always look at the risk in each of those debt mutual funds and see if they're investing into AAA assets or into credit risk, and that could be a starting point for you. How much we can allocate to invest through derivative products in market at the initial investment? I would say zero, because unless you don't understand the markets, and if you are at the initial stage, I don't expect you to understand the markets. Investing into derivatives is, like one investor said, weapon of mass destruction. Don't go there. So is investing in cooperative credit societies assuring 10% a safe and sound investment? I would not know that's individual cooperative credit society which you're talking about. You'll have to read his balance sheet and analyze the risk before you take that decision. How to select MF schemes? I think there are various ways to do that. There are a lot of websites which can help you, or else there are always advisors there to help you to select the right investment schemes. But I would say two, three fundamental things. One most important thing when you select an investment scheme is to monitor the risk or the standard deviation or the Sharpe ratio of those funds and compare that with the other schemes and try and see through the different time cycles how has that fund performed. I think these are few things which you can start from. Lump sum or continuous small investment is better. I think it all depends on your financial capability and available resources. Both are a method of investing. At times when there is crisis and the markets are down, a lump sum investment makes a hell lot of sense. And at times when you are not sure about the market, then a small investment in a continuous manner is a better way to do it. How to work out the retirement corpus. I think I have shared that in that example. Just calculate your retirement expenditure or your annual expenditure on your retirement age, and then work backwards what kind of corpus you will need, and then plan your investments accordingly. What products do you suggest for senior citizen? Again, as I said, the definition of senior citizen is very fluid. Today, human life expectancy has gone up, so it all depends on what kind of wealth size and various constraints and risk parameters which one needs to factor before I can make any suggestion for a senior citizen. Is investment in balanced mutual funds suggested for regular income? No, I would not recommend that at all. I have few mutual fund investments like small cap, mid cap, index funds, blue chip. Sometimes one has returns, sometimes the other. How do I decide? So this is where I was trying to touch upon over diversification. If you tend to over diversify, you will end up getting only market returns. So you need to be very careful in not investing into too many funds, but select few, or I would say one, depending on your size of investment in each category. Session is excellent, but to start, which can provide an Excel template. I'll try and see if I can provide that. Investing in cooperative credit society, I've already touched upon. What is your view on investing in equity and SIP through? I think both, this is two websites somebody has mentioned, Upstocks and Zerodha, though I have not seen them, but I believe that they are low cost service providers. So I think they will make a lot of sense for you to do that. And I'm sure they both provide you direct plan opportunity to invest. If they do, then you should go for it. What is SWP? For SWP on my lump sum investment, what percentage should I withdraw and when? That again is a math which one needs to factor your current income requirements and the tax and all that thing. I can't make a statement just based on zero data, but I'm sure your advisor can help you on this. What should be the criteria if we select term plan at the age of 30? I think the best criteria is that try and see how much is the minimum capital your family would need if, let's say, you were not there. And that much, if you can bear that cost of the term plan to that extent, that decides how much term plan you should have. So if you believe that your family needs, say, 3 crore rupees, at least bare minimum, so apart from all the other assets which you're left behind, or you can define it by some of the liabilities which you have. Let's say you have a housing loan or some other loan, then you want to ensure that your family doesn't have to pay that liability if you are no more. So have a term plan which covers that much of liability and more over and above that. So that could be one way of selecting the amount for your term plan. Last question, is it okay to invest whole equity component of my portfolio in index funds since it's already diversified? Yeah, there is no harm. If you believe that that is a better way to do it, absolutely fine. You can 100% do that. I think I'm able to hopefully address all the questions.
Yes, that was a real volley of questions that you were faced with, but I think this really adds value to the audience today. because I think they've got good answers to all their specific questions. There cannot be anything better than this. One question that I had, I just thought, because you touched upon it very briefly, so I just thought in case you can just highlight
Sure.
when you said that it is better to invest directly rather than go for ULIP, unit linked insurance plan. So you rather than do that, have term plans separate and investment separate. So can you just tell us about what is the differential return that you get if you go for ULIP or if you go for direct investment and term plan?
So see, this is my personal view, and I think everybody has to build his own view. But there are two factors why I say that you should not go through ULIP and go through directly investment. One is naturally the cost, because when you buy any insurance, there are two components in it. One is your mortality risk, which the insurer has to factor in, and that is your insurance cost, which is basically what comes in the pure term plan, which you land up paying even in your ULIP. And second is the fund management cost, which the ULIP will charge you. Okay, fund management cost typically is almost same between a ULIP plan and a direct plan of any mutual fund or a PMS or whatever you do. But the risk cost is an additional cost which you are incurring, which you don't need. If you already have term plans, then why incur that additional cost? And as I explained you, a small cost of even 0.5% annually can really take away a sizable part of your money. A third important thing which I've learned through experience, and it's not applicable to every fund house, but I've seen that the best of the managers who manage equity or debt largely are outside the insurances, because the amount of corpuses they get, or maybe the salaries they get, or maybe the recognition they get, is a lot more better when you see a fund manager managing a equity mutual fund or a PMS than you see an insurance manager. And in that process, a lot of time I've seen that the insurance manager or the fund manager which you have may not be the best which is available in the pool of all the managers which one has to select from. So that also in a way impacts the return to a certain extent. Not in every case, not in every insurance company, but in many I have seen in my personal experience. So when you factor all these three together, then it makes a lot of sense. And because even from a tax, as long as you're long term, you're neutral. Because even your long-term capital gains, if you stay put for 10, 15, 20, 30 years with your mutual funds, you will eventually only pay 10% at the redemption. So that is hardly a cost to worry about.
So great. Yeah. Um, Okay, and just one more question that I had. There was one question about that if you are a 30-year-old person, then how much insurance, sorry, how much term plan should you take? How much cover you should take? So obviously everybody would want to take the highest cover, provided the premium, fits into the wallet. But then there would be some cap also, right, on how much term
Absolutely.
plan can you take? So can you also just throw some light on what is the cap on the term plan that the cover that you can take?
So, Trishti, you made a very relevant and pertinent question, and I think I missed this point. Excessive diversification, as I said, reduces your actually risk or reduces your return. Similarly, by taking a very large insurance is also not sensible, because you unnecessarily are again incurring a cost which is not relevant. So every family or every earning member has to define that how much really insurance he needs. Okay. So to give you a simple example, I'm just trying to create one simple hypothesis right now. Assuming that you feel your family needs 5 crore rupees, okay, which will take care of their basic needs, your child education, some liabilities which you may have, etc. And then you have, let's say, only 2.5 crores as your assets and investments with you. Then the simple thumb rule is that you should take another 2.5 crore of insurance, so that God forbid if something was to happen to that insured person, at least his family has that bare minimum amount. So I think that's how you compute what kind of term plan or insurance cover you need based on a the cap which is there between your current assets which you have and the ideal value which you want to have, and B, in case if there are some liabilities which you want to cover and so that your family doesn't have to pay for it. So that probably will give you an answer of what that number could be. It will be naturally different for every family and every individual. But yes, taking excessive insurance is again, I would say, a big loss to your benefit.
So this also means that after a point of time when you feel or you realize that your investments have reached your target level and you're just growing beyond that, then no point continuing with a term plan,
Absolutely
maybe,
right. Absolutely
right?
right. You're a bang on. So it makes a lot of sense if you already have an X pool of money which is more than enough for your family, then why incur that cost? Because insurance, please understand, is a risk mitigation. It is not an investment tool. It is only risk mitigation tool, which means it is incurring your cost, and the sooner you can take off that cost, the best you can do.
Wonderful. I think this was a very, very nice session. A completely different kind of session. We don't normally have these sessions. We have more of technical sessions on tax and various other laws. But I think this is most important to understand how to go about investment. And you could see from the type of questions which came up that people have so many pent up questions. In fact, we have very large gathering today, and so many could not even join. They in fact they were a little late, and by the time the registration had shut, and so we could not. They could not join. But I'm sure they will be able to see after a week or 10 days. They'll be able to see this program. And I would say, Vipul bhai, this is excellent. Thank you so much for giving us your valuable time and sharing your insights, sharing your knowledge with all of us here. It has been very useful, and I'm sure this will really add to the wealth of all the people who have attended this session and who will be even watching this session on YouTube channel that we have in future once it is uploaded. Thank you so much for spending your valuable time and being with us. So, on behalf
Thanks a
of
lot.
WRC, I would like to propose this very, very well deserved vote of thanks. And we don't have a physical audience here, so we cannot really carry out a loud round of applause. But I'm sure in our minds, we do have the same thought that this really needs to be applauded to the best of our capability. Thank you so much.
Thanks a lot for giving me an opportunity, and I hope I'm useful to all the members.
Extremely.
Thank you. Okay.
Thank